Okay, let me show you something. This right here, this is what a trade war looks like on a chart.
So if you look at that, China, first row, China, 67%. That's tariff charged to the USA, including currency manipulation and trade barriers. So 67%, I think you can, for the most part, see it. So 67%, so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset?
That's the US throwing the first punch and China responding in style. Now here's the kicker. Whenever the US and China start barking and biting at each other, guess who gets caught in the crossfire? Australia. Now, why? Because Australia's economy is heavily tied to China. When China slows down, whether it's tariff, weak demand, political tensions, Australia's economy feels it. Now, combine that with the fact that the Australian dollar is generally seen as a risk currency or a high beta currency, while instead the Japanese yen is the ultimate safe haven of currencies, well, then you got a recipe for these type of moves on the Australian dollar against Japanese yen. Think of it like this. Tensions escalate, global markets go into recessionary mode, and so investors start ditching riskier assets in favor of safer ones. So money flows out of the Australian dollar, for instance, or in any case out of any other high beta currency, and also out of risk assets like equities, and instead flows into the yen. The result of that is that AUDJPY goes lower, along for instance the S&P 500. Now notice that correlation. This is very important. It's not random. It's because the sentiment driving these two is exactly the same. When things are shaky, risk off, both go down as traders move away from risk assets like the S&P 500 or like a high beta currency like the Australian dollar and rush into safe havens like the Japanese yen. And this is where you can also do cross-assets analysis and use catalysts in other assets to understand what, for instance, currency should do. So let's say you expect the US to get into a recession. Whatever reason, you expect that. And so you expect US equities like the S&P 500 to move lower. Now, that story at first sight should have nothing to do whatsoever with AUDJPY or GBPJPY or NZDJPY, yet they would all follow equities lower anyway. Why? Because of risk sentiment. Everything is interconnected in markets, and particularly big markets like bond and equities always spill over to other assets like FX. So equities dumping on recessionary fears, and you can be pretty sure that's going to spill over into safe haven strength in currencies too. So, would it be a good idea to be long the UGPY in that context? Of course not. See, this is the part that a lot of traders miss. They treat markets like isolated containers. Forex here, stocks there, bonds over there, commodities up there. All different, all isolated, all on its own. Well, no, not at all. Markets don't move in isolation, they move in waves, and everything is connected to each other. You don't have to trade every asset class, but at least you should learn to read them like the chapter of the same story, part of the same book. Now, with that said, this is to show you how important it is, once again, to understand what's going on behind the chart, because as you know, stories and sentiments drive markets. And as usual, this is not hindsight stuff. I'm not here to tell you what happened after the fact. This is stuff that we trade and we put into action every week. We saw exactly what was going on with the overall risk context. Then we spotted that big important development with Trump hitting China with the extra tariff. And so there you go. After that, it escalated even further. And moral of the story is once again, risk sentiment. I've done a couple of videos on this matter already, so I'm not going to bore you too much with the details again. You can check those videos on our channel. But if there's something that I can add in this video in particular to bring you even more value, is that trading isn't about watching charts, or better, it's not only about watching charts, because yes, charts are an essential part of a strategy. For me, there's no trade if the chart doesn't agree with it. But the chart is not the whole story. There's a whole world behind it. And so it's about understanding the underlying stories driving the charts, because when you tune into the sentiment, into the market narratives, you're not just reacting to the chart patterns, you're anticipating them, understanding exactly how the story is going to unfold. And so you get an estimate of where the market is most likely going to trend to. Now, can you get it wrong? Absolutely. Maybe you expect China to retaliate to Trump tariffs and so you position long safe havens, but what happened instead is that China ends up making a deal with the US and the tariffs get removed, or you expect the geopolitical context to move in a certain direction but it doesn't, and if you get stopped out. Now, that happens. That's part of the process, it happens. But at least you know why you were wrong. You know exactly what happened that shifted the market in the opposite direction. This is fundamental analysis.